Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, investment consultants, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. I am thrilled to welcome to our show today Ken Frier, Chief Investment Officer with Atlas Capital Advisors. Ken, welcome to the show.
Oh, thanks very much for having me.
Well, thank you for being here. Thanks for taking time out of your schedule. It's July. The summer is in full swing. Last 2 weeks of July, first 2 weeks of August is usually when people are on holiday. So we are very grateful for you making time to be here with us today.
Thank you.
Well, we have a lot of questions to ask you, but before we dive in, I'm going to read your biography for the audience. Ken Frier is a highly experienced investment professional with over 30 years in institutional asset management and investment strategy. He currently leads the investment team at Atlas Capital Advisors as Chief Investment Officer, where he oversees portfolio strategy and implementation. Over his distinguished career, Ken has served as Chief Investment Officer at the Walt Disney Company, Hewlett-Packard Company, Stanford Management Company, and the UAW Retiree Medical Benefits Trust, where he managed $60 billion in retiree health assets. He currently serves on the investment committee at El Camino Health and is a member of the trustee advisory board at AIF Global. He's also on the board of directors for the CFA Society of San Francisco. Ken earned his BS in mathematics with a computer science emphasis from UNC Chapel Hill, graduating Phi Beta Kappa and in the top 1% of his class. He holds an MBA as well in finance from Stanford, where he was an R.J. Miller Scholar. Ken, thank you again for being here. Congratulations on all your success.
Oh, well, thank you very much.
It's one of those podcasts where I don't know where to begin because you go back for quite a few years and you've done so many different and unique things in your career. So one way I think I could frame it is that you've spent over 3 decades managing these large institutional pools of capital. How has your approach to asset allocation evolved over these decades in your career?
My first CIO job was managing the retirement plan assets at Disney. And that was in the mid to late 1990s. So as we all recall, what was happening then was the bubble in technology stocks. And in addition, what was happening was a growing realization that what the folks at Yale University was doing was really pretty cool and working well. So what I was focused on in that first job was active manager selection and on trying to build out the alternatives program for the portfolio. As we'll get into later, my focus has kind of changed away from active management and alternatives and more toward asset allocation and low cost implementation. But that was how I started. One experience at Disney that has kind of stuck with me and influenced what my emphasis going forward was the crash after the dot-com bubble. All right, so I'm in charge of these assets and they're just ripping higher. The return of the portfolio at Disney in 1999 was 41%, right? So I'm in charge of a portfolio that does that well. I recognize that stocks are in a bubble and I start making some shifts, but in retrospect, I felt like I should have done more. Like everyone's talking about this is a bubble. This doesn't make sense. right? So what's the job of a chief investment officer in that environment? And ever since I've tried to sort of come up with a more systematic way to make that call of when have just stocks gotten too crazy? When should we make a shift and just have a lower allocation of stocks in the portfolio?
So the systematic seed was planted at Disney.
Yeah.
That's great. Thank you for sharing that. Well, going a little bit before Disney, you began your academic career in mathematics, computer science, which I would assume also provided a fairly distinctive foundation for how you thought about investing and how you thought about manager selection, at least at the time. How has that technical lens shaped the way that you analyze markets and make decisions over that same kind of time period? When you think about the evolution of your thought process, could you take it back to those formative years and what in the classroom has helped shape those decisions today? We have so many students who listen in and they're always interested to hear how anything that they're learning today is going to be even remotely relevant to what they're doing 20 or 30 years from now.
When I learned computer science, there was this marvelous book by a Stanford professor called Fundamental Algorithms. Mm-hmm. And in that book, he basically outlined, here's the algorithm for doing, all sorts of things with computers. And I just love that idea that there's an algorithm for making decisions, and there should be a systematic way for making decisions. So what I've tried to do, which isn't perfect, is I've tried to treat the business of investing or the profession as a search for algorithms. If I have this kind of decision to make, like how much should I have in stocks versus bonds, or in bonds, should I have more credit risk or less credit risk? Should I be long duration or short duration? Those are decisions. But with my kind of computer science mindset, I think, what's the algorithm for making that decision? Mm-hmm. If I was faced with that decision, I would have been faced with that decision continuously in the last century. So what would be a good approach? Would have been a good approach to have used the information at hand at any point in the last century and make a call on those kinds of investment questions.
Ken, thanks for sharing that. It's very interesting. And as I said before, helpful for our students who listen in and their teachers. So we appreciate that. So when you think about where you are today, and for our audience who may be slightly less familiar with Atlas, would you mind giving us an overview of the organization?
Sure. Atlas Investment Advisors is a registered investment advisor based in San Francisco. Most of the assets that we manage are the assets of high net worth people in San Francisco. So people who've made money the way people make money around here, in tech and real estate and managing investment management firms and so on. Our job is to try to generate the best investment result we can for them within the parameters that suit their particular situation. What we emphasize is smart, good asset allocation at low cost of implementation.
So when you think about the emphasis on valuation conscious, that risk aware approach to investing, can you walk us through then what that practice looks like today in effect?
We manage investments, or I manage investments on behalf of the firm, leading the investment process in the way that I described, where we have developed algorithms for making choices for client portfolios. In fact, when we rebalance client portfolios, the work is done by a big computer program that we've all contributed to for over 20 years. And the computer program embodies our thoughts about good investing. In essence, what we're doing is within the stock market, the global stock market, we're ranking top down. We're ranking regions. Do we like the US versus non-US? We're ranking sectors. Do we like consumer discretionary, infotech, financials? And then within each sector, we're ranking the stocks, right? Do we like, JP Morgan or Bank of America within financials? We pull in the information that we think is valid for rankings, the returns of stocks. We're basically using factors, or what are known as factors. They're attributes of stocks, primarily the valuation of stocks, the price to something metrics, and also the sentiment of stocks. How is that stock doing? And so those underlying factors go into the rankings that we make, and then we tilt toward what has higher rankings in a way, or we don't own what has lower rankings, and that's really the process that we apply to client portfolios. We're mostly, for our larger clients, we're mostly the direct investor. So we get paid, an asset-based fee for managing the assets, but that can be like the total cost of implementation for our clients because we're buying the stock for them or we're buying the bond for them. If we're using ETFs, we tend to go for the lowest cost ETF that just represents a beta, like an index strategy.
What's interesting about your approach is that you've very much taken the emotion out of this decision in a lot of ways. So when you think about sitting down with a potential client for the first time, and that client over the course of their career has gotten very used to hearing stories, either investment stories, stock stories, buy ideas, nightmare scenarios, all of the things that we love to hear when we're sitting in those meetings. How do you approach those conversations when you're sitting down with a prospective client for the first time and you're trying to get them to look beyond the story, look beyond the emotions?
Investing is challenging because there's facts and then there's feelings, and oftentimes the feelings can be dominating, right, and swinging things around. The kind of clients that tend to be attracted to us and that we do best with are the ones that are more technical, scientific in background. And fortunately, there's lots of people like that in the Bay Area. And so if we talk to people about our approach that is algorithmic, it's based upon academic and industry research about what really works over the long term, then that can help people, have confidence in the algorithm that we apply and get them and help them also go through the times when, the feelings that investors have toward the market cause it to swing all over the place. If they understand what we're doing and why it makes sense, then typically our clients can weather these kind of short-term volatility in the market. And we've had, almost 100% client retention. And so we've been able to do that with our clients.
When I think back to 2007, 2008, when you had, this advance in quantitative portfolios, I was at Goldman Sachs Asset Management at the time. And then leading into the crisis, as we all know, those algorithms, though, were more highly correlated than people assumed. So how do you create a competitive edge? How do you create a distinct portfolio relative to other quantitative solutions that are out there?
I wouldn't say that we have the best possible quantitative solution. What I do believe is that, an excellent way to improve your investment outcomes over the long term is to spend less money implementing your investments. And so many of the people that bring us, portfolios that, were previously being managed elsewhere, they have really high cost of implementation. They're paying a lot to the advisor, but then the advisor is investing in, mutual funds where, they get a 12b-5-1 fee, for doing that. They're in funds of funds. They're paying a lot for, investment results. And it's rare for us to see investment results where we think, gosh, that other, bank did a great job for the person who's come to us. Well, usually they're coming to us because they haven't done that well. What makes us different, I think, is that not only do we keep costs down, but we're unemotional, we're systematic. And so we think if we just stick to our program over the long term, then we'll be able to create a result that's certainly going to be competitive with the competitors in private wealth management, but also is competitive relative to what professional institutional investors are doing with their portfolios.
Ken, when you think about your own background, and this is maybe one way to ask it, and I could ask it in a more clever way, but I'm just going to ask it how I was thinking it, which is what makes you different? What makes you different as an investor? When you think about the experience that you've had over your career and you think about what you're doing today, I makes perfect sense in terms of Atlas. It makes perfect sense in terms of the algorithms and understanding what you're trying to solve for your clients. But when you think about that client who's still sitting across from you, what makes you unique relative to the experience that a client can expect?
What I've done that the majority don't do is I've tried to answer the questions myself, like do my own research so that I really understand the foundation of the choices that we're making. It's easy to get someone else's choice, Like, if you want to know, like, how much should I have in stocks and bonds? Well, you could ask JP Morgan, ask Goldman Sachs, ask, BlackRock, and they'll say, well, this is what you should do. But if you don't understand, how did they come up with those suggestions? Like, what's the underpinning for making good choices? Then you're really not a good investor, in my view. So I've tried to be a good investor by knowing enough that I could like challenge BlackRock. They say we should do this. I say, but that doesn't make sense. Like, why are you assuming the return on this will be that? So knowing like the underpinnings for investment recommendations, like how the sausage is made, is really important.
Mhm.
The other thing that's important is the emphasis on asset allocation. It is rare. What we do is
Mhm.
really rare. And that is have willingness to change asset allocation. In fact, most of the people in our industry make a virtue of doing nothing, right? They say, timing the market is more important than timing the market. And
Mhm.
we're not market timers. And sometimes what that boils down to is we just don't think about what's happening. Right.
Yeah.
And so because we decided, 10 years ago it was going to be 60/40 stocks and bonds. And we don't think about whether that makes sense right now. I would wager that almost everyone who might listen or who manages portfolios has the same allocation to fixed income now as they had 5 years ago. And so if you just think about how much things have changed, 5 years ago, the 10-year treasury yield was, 0.6%. And, now it's 4.6. That's just a
Mhm.
dramatically different investment proposition. So if you were paying attention, you should have more fixed income now than you had 5 years ago. But I would wager that most people have about the same.
I speak to a lot of those people. I think you're going to win that bet. I think they'll have different reasons as to why they remain static in certain environments. People like to talk about the noise and ignoring the noise.
Yeah, just think about what was happening at the beginning of 2022, right? At the end of 2021. Inflation, the prior year inflation was 7%. The 10-year
Mhm.
treasury yield was 1.6. Most of allocators have a return requirement of, inflation plus 5. And so here you have an asset which at the moment you're looking at it is almost inflation minus 5. And
Mhm.
yet investors are still investing in that asset. It makes no sense
Mhm.
relative, right? Well, in the rest of the world, you have a lot of treasury bonds with negative yields.
Mhm.
And so
Absolutely.
anyway, I think that sometimes, not usually, it doesn't. Yeah, people who've tried to shift assets, there's a lot of horror stories of, people who tried to actively allocate and they weren't happy with how things turned out. But sometimes, when you're at the edges, you really should do something. The whole um, kind of mindset of most people in our profession is you never do anything about anything.
It's a great point, and I don't disagree in a lot of ways. I should say I don't disagree across a lot of asset classes. However, we are seeing, generally speaking, we're seeing more asset allocation decisions happening in alternatives right now, particularly coming out of the endowments for a variety of different reasons. There's not one reason, but there are a couple trends that you've written about actually and have talked about in your own work. So how has your approach to asset allocation within alternatives evolved, and what does it look like today? Do alternatives have a place in your portfolio?
Well, the interesting thing that's happening in alternatives is that the benefit is in decline.
Mm.
It's really clear that the amount of advantage available from investing in alternatives is not what it once was. Like when I was
Mm.
at Stanford, I analyzed how we done in our alternative investments relative to how we could have done if we'd made similar choices in liquid markets. And there was an alpha. Stanford had, done better in alternatives.
Mhm.
That was 15 years ago. If you look at, say, the Yale endowment, right? The Yale endowment was renowned when I started my career, still is renowned as being about as good as you could possibly be
Mhm.
at investing in alternatives. If you take the 10 years ended in 2004, take that 10-year slot, the
Mhm.
Yale endowment performance was 6% per year better than they could have done with a simple stock bond index strategy. Take the next 10 years, 2004 to 2014, Yale endowment performance was 3% better than they could have done with a simple stock bond index fund. Now take the most recent 10 years ended 2024. The Yale endowment was just 1% ahead of what they could have done with a simple stock bond index strategy. And moreover, their performance is fake. Yale is now trying to sell their private assets, and they can't get anywhere near the reported value for the assets that they're trying to sell. And so even if they beat a stock bond index fund by 1% per year, if in fact their whole portfolio is worth 10% less than they're reporting it to be worth, then there was no edge by them at all. So this is Yale, like the best of the best. They have just a fantastic team, fantastic governance, fantastic resources and budget. Our view is that if the best of the best is barely eking out an advantage from alternatives, then we really should think about being good allocators and keeping costs down rather than just trying to chase this sort of diminishing advantage that might be available from alternative investing.
Is there any alternative exposure in the portfolios?
I know alternatives, and I've selected alternatives, et cetera. And so we sometimes have clients come to us that previously have illiquid positions in their portfolio. We don't add alternatives to client portfolios. In fact, we've done a whole series of videos you can find on YouTube. They're called the Alternative Investing Reality Check. And what the series of videos indicates is that if you properly analyze whether you're really benefiting by being an investor in alternatives, then in the middle of the distribution, like the average outcome is not good relative to what you could achieve in liquid investments. We all know that there's an enormous dispersion of outcomes within alternative space. And so if you're Yale and you just have the access and you have a fantastic team, and so you can make discernments between who's going to be that top quartile manager, and well, then you should keep playing. But if you don't have a Yale quality team, then you shouldn't play. And so I think the disappointment is going to start rising, or it already is rising because of the lack of exits. But I think it will continue to rise. People will believe, but it'll take a long time. 10 years from now, maybe 5 years from now, people will say, wow, my alternatives portfolio isn't really delivering what I hoped it would.
Yeah, many of those trends that you're talking about are on the private equity side. I'm curious about your views on the private credit side. There's been so much growth, and I know you've written a little bit about it as well. So I'm going to let you tell the audience about your views. I have a sense, but I would love to hear them.
If you just looked at the historical track record of private credit, you'd think, wow, this is a fantastic asset class. All right. I think that like 20-year return for private credit is like 10% per year, and it's lower risk than equities. And geez, if you can get 10% per year, it's lower risk than equities, then back up the truck and fill it with private credit. The thing is that it's kind of an untested asset class. I mean, the last time there was a financial crisis was like 2008 to 9. And the private credit category was teeny back then. It was like 200 billion maybe in private credit then, and those funds got smashed, but it was really small. Now the private credit market, just the U.S. private credit market, is 1.6 trillion. So it's as big as the public high yield market, right? So it's an enormous source of funding. It hasn't really been tested yet, and so although the historical track record looks really good, we're going to learn things when or if the next financial crisis happens. If you look at publicly traded private credit, look at business development companies, it's the same kind of asset, and they're enormously risky. If you, when we had stock market meltdowns, like even the blip meltdown in 2020 during the COVID pandemic, I mean, business development companies fell in value more than the S&P 500. There's incredible risk there. If there's like liquidity issues, and if people, if there starts to be an escalation concern about credit quality in the economy, the National Bureau of Economic Research did a careful study to determine whether private credit managers have skill. And the results were really interesting. They said, well, yes, indeed, private credit managers have skill. the annual return of the assets they're selecting is 4% per year, better than if they had selected liquid public credit assets. That was the good news. The bad news was the average fees being charged by these private credit firms, it's 4% per year. And so if you take their edge, the 4% per year that they're making from good choices, but then you subtract the 4% per year they pay themselves for making those choices, then you really haven't been better off.
Yeah, I'm just as an aspect of this conversation as well, which kind of is riding under the current of all this, is liquidity. So when you think about liquidity at Atlas, what does that discussion look like as it relates to clients, and how do you see that as a principle of the business?
Well, we believe in providing maximal liquidity for our clients. If one of our clients wants all their money tomorrow, they can have it, because unless we inherited some illiquid position from them. But we're in liquid stocks, liquid bonds, and that provides maximum transparency and maximum flexibility for our clients.
Is there any external manager exposure in the portfolios?
We do use ETFs sometimes. We have our own municipal bond program, but if we want fixed income assets for clients that we don't do, we don't do high yield, or we don't do emerging market debt. So if we wanted those categories for clients, then we would do that. And sometimes we do. We do that via ETFs. So in the ETFs, we're just looking for beta exposure at low cost.
So you won't be incorporating any qualitative assessment of the teams. It'll still be strictly quantitative.
Yeah, we're just trying to get an index outcome. So we're not evaluating a team. We just really want an ETF where the algorithm is, we're going to own this asset class. We do that with small cap stocks too. We just use ETFs because our universe for buying stocks for clients is the Russell 1000.
Yeah, how about just your thoughts on the growth of the ETF market? If I had a nickel or probably $1, I need $1, but $1 every time someone called me and said, an active manager and says, I'm thinking about launching an ETF. What do you think? How should I go about it? Do you think that there's an approach to this? It seems like it's a different sales approach, a different sales cycle. How have you seen the ETF market in your seat in particular, and that you're incorporating those types of strategies, those types of securities into your portfolio construction?
The evolution that I've seen is that ETFs started out just being index replication kind of products. Most of the money that went into ETFs was, SPY. We just, own the S&P 500, but we get it via an ETF, or we own the infotech sector, or we own Japan, and there's an ETF for the index. And so that was the initial growth. And what I'm seeing now is that the growth of ETFs, it's eroded the mutual fund industry. And so many of the investment management firms that were strong in mutual funds, they're now repurposing their strategies to be ETFs, which now they call active ETFs. So that's a more new thing. But I think that's just the way it's going to go, is that mutual funds are dying out, and everything's going to be an ETF.
I think you're right. I think that's why I think a lot of calls are happening right now. So very interesting. I'm curious. We have a lot of sales professionals who listen to the call. A lot of allocators, a lot of sales professionals, educators, and students. But when you think about the sales professional who's representing a systematic strategy, do you have any advice based on your experience, that what you've witnessed at Atlas? What has worked the most for you and your colleagues when you're sitting across the table from that prospective investor and trying to sell? I know black box is cliche, but you're selling a black box. You're selling something that's difficult to maybe understand unless you really understand the mechanics of what you're trying to accomplish. What have been some of the tricks or the standards, I should say, that you've utilized that have helped you all raise assets and awareness?
What we tend to do is kind of have walk through some of the charts from the academic research. It doesn't work for everybody.
Yeah, it's funny. I'm thinking, the reason I ask, I'm thinking back to my Goldman days, and I remember I have a story. I was in my office, and My colleague knew that I had a pitch in 20 minutes, but I was doing something else, and he said, "Hey, don't you have a pitch?" I said, "Yeah, but it's with one of the quant hedge funds, so I don't really have to say much. They'll do all the work." So I'm curious just how you think about that. I know it's not easy in a lot of ways.
My partners and we just stuck with our identity as like investment nerds, and so we just present data about not a lot of pages. We don't overwhelm people, but we present data about here's why we do things the way that we do, and here's the evidence that we get from esteemed academics, et cetera,
Mm-hmm.
about why what we're doing makes sense. And so we've stuck with that. And it's resonated with enough people that we've been able to grow over time.
How often are you having to discuss or incorporate conversations around artificial intelligence as it relates to your program?
There haven't been that many discussions. I expect probably there should be, other than artificial intelligence as an investment proposition. And is the boom in the mega cap technology companies in the U.S. sustainable? And is this concentration of valuation in the U.S. stock market going to lead to tears eventually? So we have conversations about that. More Magnificent Seven, avoid Magnificent Seven, things like that. I'm interested in the question about can artificial intelligence help make better investment choices? I expect that the answer is yes, but I also have in my career experience with sort of black box strategies or quantitative strategies that didn't work out well, and I've been cautious about trusting a program where I don't understand how it made the choice. Like, what's really, I always want to understand why did it buy this stock and not the other stock? And so if it becomes too much of a mystery, it's just, we have this great program and it says, buy Coca-Cola. Then it's hard for me to accept it if I don't understand how it works.
That makes sense. And that's definitely been a theme through this conversation. I was thinking about I can't help myself as we're talking. I always think about what I would call or title this episode. And I think it's going to be doing the research with Atlas Capital, because you're doing the research, which I do think is unique and distinct. And I think how that research, understanding not just the parts of the car, but how it's built, I think are very important. I think it's unique to what you offer the market today. I love boats and I love rowing boats. And I was talking with somebody over the weekend saying it's a tool that hasn't changed much in 1,000 years, and there's a good reason for that. But if you get to understand the parts and how it's built, you'll have a different view on how to utilize it. And it sounds like you're taking a similar approach, so I appreciate that.
I love boats as well. My family had a little sailboat, and I spent a lot of my youth on the water sailing.
Yeah. Yeah, I think there's something mechanical. No, yeah, it's funny, and I think they haven't changed much at all. And there is something I think that mechanics of it, the underlying the underlying structure of the device and how it comes together. I think it's amazing. And but it's not all Atlas. You do serve on some external advisory boards and investment committees, Alaska Permanent Fund in the past, AIF Global, El Camino. What do those outside perspectives help bring to the table as it relates to your work at Atlas?
It's been interesting, being on the Alaska board and on the El Camino board. They are, both organizations are they're still on the mindset that we're going to do better with growing our alternatives program. And so since I'm not really paying much attention to alternatives otherwise, then being on those boards or, engaging with those, it helps me, understand what the conversation is, who the good managers are, what the performance is like. So that's been interesting. And some of the investment professionals have been really, really excellent. The main takeaway from these experiences is it's a different perspective. I spent 25 years reporting to boards as a chief investment officer, and now like participating on boards, like on the other side of the table, and it's caused me to reflect more about what are boards good for. What should they do? What should they not do? And my preference is for boards that don't make investment decisions. I don't think a board is equipped, even if it's got, people like me that know about investments, we're getting
Mm-hmm.
together for a few hours every quarter. And so we shouldn't really make decisions about
Mm-hmm.
how to react to, changes in the market or the economy. In my, experience or talking to lots of other chief investment officers over time, there's a lot of boards that get in the way of the investment program, particularly if the board gets involved in selecting the managers,
Mm-hmm.
which, neither of the organizations I do, the board, uh, you know, doesn't weigh in on invest, or often a board, especially in political contexts, will have their own agenda, right? They want to
Mm-hmm.
promote clean energy or promote
Mm-hmm.
diversity or promote labor union rights or, things like that. And so you can have a board and they're well-meaning, but the more that the chief investment officer has to deal with about agendas to apply to the investment
Mm-hmm.
program, the harder it is. I think the main role of the board should be just to judge whether they have the right people doing the
Mm-hmm.
work and to challenge them sometimes. Like, how are you thinking about what tariffs will do right now? Do you think inflation is done going down and will go back up, or do you think we don't have to
Mm-hmm.
worry about that? This like the big questions of the day. A board should, make sure that their chief investment officer is thinking about those things and has a view about it. But otherwise, I think, should mostly get out of the way. The big challenge that boards, I think, create for their organizations is they usually reserve for themselves the job of deciding on the asset allocation.
Mm-hmm.
And we all say the asset allocation is the most important decision. But I think we can also say that boards aren't really equipped to make good investment decisions by
Mm-hmm.
their nature. And so the most important decision is a decision that is made, once a year or some places once every 3 years, and usually not much is done. And so the potential to add value by making choices as an allocator just gets lost almost everywhere. So that's the distinction that we have at asset allocation
Mm-hmm.
at Atlas, is that we can do something or will do something about asset allocation, but in most contexts, because the board is in charge and the board will be reluctant to do much, make many changes, then not much ever happens in asset allocation most places.
That sounds like a good paper. I would love to read and for you to expand on. Thank you for sharing that. I always like to ask our guests as we get close to the top of our conversation. You've been at this for long enough to have worked with many people over the years. When you think about those folks who were most influential, most supportive for you in your career, who are some of those mentors that have really helped you along in your journey, and what were the attributes that they brought to you that made it so beneficial?
My experience at Hewlett-Packard running their retirement plan assets was terrific, and it was part because I reported to a brilliant chief financial officer, and so she was a finance person. She understood what I was trying to do. She trusted me and gave me a lot of
Mm-hmm.
flexibility to do what I thought was best for the portfolio. And the results my team and I delivered were fantastic in that
Mm-hmm.
kind of environment. So I really appreciated having that kind of governance where even there was a board, but in that context, I was mainly reporting to her, and she was terrific. So that was helpful. I've really enjoyed in my career the engagement with brilliant people. I mean, our
Mm-hmm.
profession has lots of like really brilliant and interesting people.
Mm-hmm.
As a CIO, I mean, it's a privilege to go all around the world and talk to really smart people about how they're thinking about investing. I have always especially gravitated to the people who've do research. Like, this has been like one of my Bibles. This by Antti Ilmanen at AQR. He's fantastic. He wrote another book that's up here somewhere too. But if you're going to allocate, you need to know, you need to have like a theory about
Mm-hmm.
what's a reasonable expected return for all the choices on the menu. So I love talking to someone like Auntie, who's just so brilliant, who's just thought deeply about like what's the expected return for stocks really, or for fixed income, or for commodities,
Mm-hmm.
or for hedge funds, or anything else on the menu.
I'm going to ask you to get up again. I have a question. In your bookshelf in the back, are those records in the back?
Oh, Not records. No, those are music.
It's music. Okay, so
Yeah,
if
yeah.
you had to go and pick out, I remember that you said that you like to sing and you sing in groups. So what would you pick out off that shelf of the music that you love the most?
So here's what I sang last night. It's Mozart Requiem, and it's fantastic. And it's just just seeing Mozart, and this is like one of the most wonderful choral works ever created, and doing that with a group of excellent singers is it's a privilege to do that. So
Thank you for sharing that. That was one of my favorite moments from the last 3 years. Thank you for that. Ken, thank you for joining us today. Thank you for sharing your journey. Thank you for sharing more about Atlas Capital. It's been a pleasure learning about you and learning about the organization. We wish you nothing but continued success.
Oh, well, thank you so much. It's really been a pleasure talking with you, and I hope we'll get a chance to meet in person soon.
I hope so too. You always have an invitation to Drexel University in Philadelphia.
Thank you.
Well, if you'd like to learn more about Ken and the work being done at Atlas Capital Advisors, please visit atlasca.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also available on YouTube if you prefer to watch while you listen. And for more content, please visit us at dakota.com. Ken, thank you again for being here. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.